Hey guys, Freaky Finance here. Last week we did Albertsons, which turned out to be good timing. I didn't even think earnings were on Tuesday, but anyway, it was good timing for the video into the earnings. So that was another good call on a defensive name at a time where it made sense to look at it. Here we're doing another defensive name. Again, this is the theme. In October, I'm looking at ones that are at 52-week lows that are good businesses. I'm familiar with CAPREIT. We actually haven't done a residential REIT on this channel, but I've owned CAPREIT back in 2019 and 2016, so I'm familiar with it. We'll go quickly. It has similar to our other REIT videos, so I don't have to spend as much time on the background of what a REIT is and how they pay things out. But there's a certain reason why I'm doing this today, and part of it is because the price is finally back to where I think it's exciting. And this is, in my mind, one of the more defensive REITs out there because it is so stable. And we're going to talk about rent control and the effect, and I think that's a catalyst for this company at this time. And then obviously I think rates are going to continue to go lower as things get worse in Canada because rates are still too high. And REITs got hit on the way up with interest rates, and they should actually start getting better on the way down. Now, residential in Canada, especially in Toronto area, is starting to sell off because rates have been high for so long, right? Everyone's now had to be hit at a higher rate than what their old mortgage used to be in Canada because most people have 5-year fixed. So they're all getting hit, and it's putting more and more pressure on this space. And then you have immigration slowing down relative to what it was. So you have less people, and that puts downward pressure on property prices. So that's the time when I like to look at property prices. So that's why we're doing the video today. There's also another catalyst here is the NAV discount is widened, which is not something you'd expect at this time. But for this company, they're also selling assets in Europe at IFRS value, so fair value, and they're able to buy back and invest in the Canadian business here at these discounts. Well, the assets are cheaper than they have been for a while, which is another thing that I like. So they're getting cash inflow at a time when they can take advantage of the current situation. So that's another reason why we're doing the video. But anyway, here you can see over time, the stock price has traditionally followed the NAV. Like I said, I owned this before in 2017 to 2019, 2016. And it does follow the NAV over time. However, sometimes it goes above, sometimes it goes below, especially during COVID panic shutdown, right? But it kind of mean reverts back up, or it has historically. But there's been shocks lately in the residential space in Canada that have basically stopped that from mean reversion from happening. And part of that is the higher rates have been so high for so long now, for 5 years. So it's put a downward pressure on this relative to what the property values are, even though they have been writing down the property values already over the last 3 years. Anyway, in terms of exposure, you can see it's very much Toronto and Ontario, right? 52%. But you can see overall relatively spread out exposure in Vancouver and Victoria as well. Here, just to show like the value proposition is really, most people are aware of what apartment buildings are, so I have to explain. But you have a lot of tenants, so the tenant risk is very low. Here's just a property list, and one of the things that's nice, I always look at tenant risk when I'm looking at a REIT. This one, just because there's so many different properties, there's a really big REIT, so many different properties all over Canada, and none of the properties are more than 2% for the entire organization. Like there's one here in Montreal, that's 2%. But you can see how fragmented it is. No one has power over the REIT, right? It's not like there's like a tenant that has like an Amazon that has 25% of their revenue coming from Amazon. Right, it's just super diversified, and that's what I like to see. Most residential REITs are naturally diversified, though it depends how many properties they have. Ultimately, you always need to be aware of the geographical risk if there's a certain area that's getting hit all at once with a certain activity that they're overexposed to. But you can see it's relatively spread out, and there's not a lot of concentration at all. There's only 11 properties that represent more than 1% of the business. Anyway, I thought that was interesting. I should disclose that I do own this one. I just started positions in it. What else? I guess I could also share started positions in CNR, right? Just relatively cheaper defensive names that have sold off over the year. And that's what I look for in October, right? Salesforce, another one, kind of shot up a bit today, but whatever. Still, that's not a defensive play. But I just wanted to show that I do own this company. Before we jump to the NAV, let's go back here. I mean, most people know what the business model is. Basically, it's a collection of monthly rental payments from tenants, right? So it's stable, predictable cash flow. People are going to pay their rent or else eventually they get evicted. Very safe, in my mind, very defensive, especially over the long term. Like things could happen in the midterm, middle term, short term. That put pressure on the REIT, right? Property prices decline, unemployment shoots up, people can't pay rent. That pressure always happens in the cycle. So we're not technically there at like where I start pounding the table to like buy this REIT now. It's kind of just like, this is an interesting REIT at a specific time because of how much it's gotten hit over the last 5 years. And the business has gotten better over this entire time. So it's another thing I want to point out. The actual operations have gotten better while we're getting a cheaper price. What else should we say? We should talk about the RDVest in European portfolio, return as a pure play Canadian REIT, in parallel engaged in its high grading or asset recycling. So sale of older non-core properties that may have lower growth profiles or higher capex expenses, and then are redeployed into the primary channels, acquisition of newly constructed high quality rental properties, and aggressive for purchase of its own trust units. And we'll go to some other reasons why they're probably looking at that as well. In terms of the rent, I like to focus on the left here, just the rent bucket. You can see most people that are paying CAPREIT pay under $2,000 a year, 80% of them, which is pretty special, I'd say. It's lower than I was expecting, given where they're located, right? So it does mean that there's still relatively, in my mind, cheaper rent, especially relative to the housing appreciation that we've seen in Canada in terms of house prices. So I'd say that the ability to rent's probably easier than the ability to buy a home. Probably still true today, even if housing has started to correct a bit. What else is going on? So right now, people are expecting less population boom, which does affect supply and demand of apartments, right? So basically, if there's more people, apartments would, in theory, have ability to take more price until supply catches up. Now, one of the things that's happened in Canada is with the price caps that we're going to talk about, there isn't that price signal for more supply to come online. So more supply is not coming, and people are slowly getting squeezed as rents slowly appreciate based on what's allowed. Basically, one of the reasons why is when you have a cap on what you're allowed to charge people year over year, it basically makes people who are thinking about building new apartments say, why would I build new apartments? Why would I take a risk now when my tariff input costs are going to go up 50% and I know I can only push 2.5% price year over year, right? So that's what's happening, and it's one of the reasons why caps on rents don't work. And we'll talk about this. The AI has some good points on this, but in practice, it sounds like, okay, rents are too high for people. Let's cap it. Let's help them out, and that's fine. But then you have these second level effects and the unintended consequence of trying to do a good thing is how I'd word it. So anyway, here you can see how affordability for housing is spiked in Canada, and now it's coming back down, mean reverting. So basically house prices went a little bit too high, now they're correcting. Rent usually plays catch up on a leg, and part of that is because of the caps in rent. They weren't able to push. When inflation was gone 10%, CAPREIT could only push 2.5%. So all their utilities went up, running the properties went up 10%. All their input costs went up 10%, but they could only push 2.5%. And basically what's happening is they're slowly catching up. And there's other things that are happening, and we'll talk about that as well, but what they're able to reset during the turnover of a tenant. They can capture that spread that they've been lagging behind, which we're also seeing. What else? In Canada, you do have more unemployment again. It's not quite at crazy bad levels, but I'd say it's not at good levels anymore, right? We're way worse than what we were in 2017, 2019, right? So the economy is already worse than then in Canada, which is another thing I like to look at, because that's usually a time when these REITs will come under pressure, especially on the tenant side, right? Because then your occupancy slowly goes down, people can't pay their rent, you have higher bad debt expense. That happens, and that's usually when you get the best deals on REITs, because that's also when the NAV discount widens even more. So anyway, here you can see the average age of Canadian home buyer just continues to go up because it's so unaffordable. It's another metric to measure affordability when people are taking 7 more years to buy their first home, 36 instead of 29. Right, so basically the younger generation hasn't been able to buy a home. One of the things we're doing in the video today is because we're already at past peak interest rate rise. Inflation's already, in my mind, been killed in Canada, and now they're slowly killing the economy because they're too slow to lower rates. So here you can see the rates slowly coming back down. Analysts expect it to sit at 2.25 for a long time, so after the next decline in rates, which should be sometime before the end of the year, I imagine. They'll just follow America, even though they're a weaker economy than America's economy. So anyway, that's just my thoughts on how poorly the monetary policy in Canada has been managed. But anyway, we should see rates continue to go down, which is favorable to REITs. And if things get really bad in Canada, then you'll even see rates go back down to these crazy panic levels, which is usually when you get even the best deals on REITs. In terms of the rising AMR, so the average market rent, just monthly rent, just keeps slowly chewing up over time, as you expect, as their lease renews. Their yearly kicker of 2.5%, whatever they're allowed to charge, goes up. You can see it just slowly ticks up over time. So they slowly make more money per suite that they own. And occupancy has held in relatively high. Usually occupancy is really high. Apartment, usually people need a place to live. We can jump into numbers in a second, but what I want to just point out here, we talked about this before, is the fair market value of REITs. Basically, REITs, when interest rates rise, they basically have to mark down their property values. Their property values could be going up, they still have to mark them down because the cap rate has gone up higher. And that's what happened in early 21. And ever since then, really, and you'll see this in the history of the REIT over the last 3 years anyway, the REITs been marking down their assets. So the REITs have already been marking down their property values for the last 3 years, right? So the fact that people are like, oh, property values are going down, it's like, that's fine. That's currently what's happening. You're finally seeing it. But the REITs have been marking down their property values for the last 3 years already. And this is not small amounts. This is $1 billion for a REIT that only brought in $1 billion in revenue, right? So you're going to notice that. And we talked about the accounting noise when we looked at other REITs on how this line basically makes or breaks the EPS for a REIT, which you never use as a metric, but people do. Anyway, what I like to look at is just, hey, what's the net operating income? Is it going up or down? Are rents slowly going up like we thought? Yes. Right? Are the expenses in line and they're well managed? Yes. So everything here is fine. Maybe we'll jump to the numbers before we talk about suite turnovers and lease renewals. Just the metrics on it. And here you can basically see a slow trend up over the last 5 years, not including 24. So I went farther back. I just wanted to see how, because this is when I left last time I looked at the REIT, right? They're only making 210 and FFO 240. I'm getting the same price as what it was in 2019, right? So the company's about 20% better. That's one way to look at it relative to what it was last time. You can also see average market rent has gone up quite a bit, especially in the 22 and 23. You can see 21 surprisingly low given how much inflation we saw, and a part of that is because they're just slow to raise it after the fact because they can't. Here you're seeing same property NOI growth. You'll see sometimes it's much higher than say 2.5% or 3%, and that's because of the spread. So once a lease turns over, they're able to charge more if the lease term's over and they do some work in the rental suite to make it better. The new tenant comes in, they can charge a higher rent. So anyway, here you have a decent payout ratio. It hasn't been over 100% for a while. These are all AI's comments on the right here. These are like little metrics that I asked it to do for REITs, and I'll probably expand on it the next time we do a REIT. I kind of wanted to see what the AI was capable of doing. Here you can see the NAV already climbed down. Like I said, property values have already been marked down a material amount on the books, well ahead of the decline in actual property values that we're finally seeing. Anyway, the NAV discount has widened from 20% roughly to 24%. Now it's at 28% based on current price. And that's not necessarily a timing indicator. That's just I know I'm getting a better deal in the long run. And these discounts can widen much further, like we've seen material widening in diversified REITs, office REITs, right, where there's more fear. So usually you get a big discount when there's a lot of fear, which is usually during a recession for this type of REIT because it's so big and broad, but everyone is connected in the economy, right? So when unemployment goes from 7 to 10, that's a lot less people that can start paying rent when you don't have a job. It's worth bringing up. One of the things I like about this company right now is that they're selling assets in Europe at their current asset value, and then they're able to buy back their shares at the current discount, which is widened. So basically that's value that's accruing to us, the shareholders or the unit holders. And it wasn't small, it was over 5%. So that's on top of the 4% divvy. So it was a 9% return, which is pretty strong. Well, the unit price has only gotten cheaper as more and more people are seeing in the news that property prices in Canada are finally starting to correct. Again, that depends where you are. The AI thinks that the discount could narrow based on monetary policy pivot. I mean, I don't know if they're pivoting, they're just continuing a trend that they've been slow on doing. It's just going to continue to slowly decline, and interest rates will help REITs. Continued operational excellence, that's true. They have been operating at a high level. The things that they can control, they don't control interest rates, right? They don't control the economy. They don't even sometimes control the rent that they can take, but they've been operating very well. And then the completion, I do think the AI's right here. Once it's all just Canadian property, it's just it'll be easier for people to understand what the REIT is about. The enduring risks are kind of fun, so higher for longer, economic downturn. So you can have both these things at once, hopefully. Usually if there's economic downturn, you would see the higher for longer narrative completely go away, right? And it's kind of already gone away. And then you have operational cost pressures, and that's true. Though again, if you're going to have economic downturn, usually you don't have operational cost pressures at the same time. Usually everything slows down together. So your revenue goes down, but your expenses also kind of go down. It kind of depends on your expense structure. They shouldn't accelerate anyway. This is just the legal cap. I wanted the AI to talk about it. Basically, legal cap is the maximum percentage of which a landlord can increase rent for an existing tenant to renew their lease. So that's when you sign a lease, capped at how much you can increase the rent year over year for duration of the lease. It's good for the individual, bad for the company, but bigger than that, it's also makes it less likely that more companies are going to build more supply, which would then actually help lower rents. And that's one of the things that people who are very raw rental caps miss and don't understand. And that's why you never see a cap actually work in lower rents. All it does is just delay the increase that's going to happen. And then you never have a supply response, so you never overbuild shelter. So basically it's a way that you ensure shelter slowly goes up over time. And it's also a way that's why you're squeezing out the younger generation as well. It's ironically enough because of the solution that you have. Anyway, inflation's been higher for a long period of time, especially over the last 5 years. And they have rents. We kind of skipped over a slide, but they had rents for like a lot of them are 2 years, 3 years, 4 years. They actually have a decent amount that's over 10 years. So when inflation's been higher than that for a long period of time, you're only allowed to take 2.5% or whatever it is a year. So when the lease comes for renewal, the landlord can then mark up to whatever the market rate is, get a new tenant or renew with the old one, but now at the higher rate, right? And this is good for the company, bad for the legacy tenant. So that's what I want to point out. Now, a suite turnover refers to the process when the tenancy ends and a new one begins, but the event is a trigger for vacancy decontrol, which allows the landlord to reset the unit price at the prevailing market rate. Therefore, this increase is not small, a regulated increase like the cap would be, but rather it can be a significant leap that captures the accumulated spread to market. So basically it's the catch-up mechanic. So you can delay me increasing rent on my tenants, but once the lease is over, I'm going to increase the rent based on whatever I'm allowed because rents have gone up higher than what I've been able to charge. Upon the tenant's departure, the landlord is legally permitted to lease the now vacant unit to a new tenant at any price the market will bear. And this creates, and the AI is spot on here, I didn't even ask it for this, it creates a direct and powerful financial incentive for landlords to encourage tenant turnover. So they may not want to work with you if they know that you're paying $2,000 when they know this thing could rent out at $2,500 and they don't have to put any work in to do it, or very little, right? So it encourages friction between landlords and tenants as well. That's what, ironically enough, what these cap things do. It creates friction at a specific point. Basically, it's delaying reality, and it's also delaying the price signal that would ever result in more and more supply coming onto the market. That's why property prices haven't been as cyclical as they have been in the past. They've been more linearly going up to the right, especially in relation to the average wage of a citizen. Transforming each turnover from a potential cost center into a significant revenue-generating event, it also creates systemic tension, which we just kind of talked about, as the landlord's duties to maximize returns for unit holders can conflict with the goal of housing stability. By upgrading kitchens, bathrooms, and flooring between tenancies, the landlord not only justifies the new higher market rent, but also enhances the asset's long-term value, making the unit more attractive. So that's kind of how they're doing it, and it also helps them as a shield as a landlord. You're like, okay, I can increase the rent now because I've put some work into the building. Here I was kind of like that. I wanted to talk about the economic theory of it. Basically, the result of a cap is a persistent gap where the quantity of housing demanded exceeds the quantity supplied. The gap is by definition a housing shortage. We talked about this because there's a cap. No people build, or less people build than otherwise would because their price signal isn't there, which just leads to a continued shortage for longer. As ironically as rent control is almost always implemented in response to perceived housing shortage and high prices, right? They only exist in BC and Ontario for a reason, because they have the highest prices and they're out of control, but so they put caps in, and ironically it just made things worse because the economic model predicts that the policy will exacerbate the very problem it's intended to solve. And that's what we've seen over and over again in history. And we still see more and more people try to say, well, let's cap rents, and then it's like, no, you need the markets to correct it, or else you're just delaying and making the problem worse. It's basically smoothing it out, making it worse for everybody in the long run. Anyway, here, in terms of the operations of the business, very stable. Again, we talked about average monthly rent, so now it's at 1.5, now it's at 1,600. Operating income still slowly chugging along up, which is what you want to see, right? So you have things still slowly chugging along, getting better, while this business is selling off, and that's why I'm doing the video today. On top of the other things like selling their European assets at their IFRS value, being able to buy their remaining units at a significant discount, more than they've been able to buy in the past. And they just got $222 million from a special distribution from REIT for these properties that they've sold. We'll see what they do with the cash there as well. So again, they have a cash inflow at a time when there's things that they could finally start buying, right? And they're looking at newer buildings that don't require as much capex, which is interesting because it's likely that they're able to capture the current market rents better, right, as well, which are higher. Anyway, we've kind of talked about the NCIB a bit. It's been a thing for a while. Now that it's under $40, it's even better, right? So they had a weighted average of 45 for the NCIB. We haven't really talked about the debt load, but it's fine. Usually I have my own metric is like 30 to 40. Under 30 is like amazing. 30 to 40 for total debt to the asset book value is pretty good. And then once you get around 60 is when it gets dicey. It's where you really got to know what you own. That's just kind of my rule of thumb. It'll always depend on the REIT and the type of REIT, especially. That's just kind of my rule of thumb. So in terms of the debt level, it's fine. And this is on top of the write-downs they've already taken for the last 3 years. Oh, I should have showed that a little bit clearer. Here is just the the write-downs. So when times are good, you can see the assets slowly increase in value, right? Boom, boom. When rates shot down, they actually saw an increase because their cap rates went down because interest rates shot down to zero because we were panicked, right? We didn't have a vaccine. And then you had the return of high inflation, so they had to shoot up interest rates to help fight that. And basically they had to mark down their property value. So they've already marked down their property values by $2 billion. And we just saw in 2024, and the comp set that was another $1 billion. So they've been basically writing down their asset values by a material amount already. And despite that, they're still only at 38.5% debt to gross book value, right? And the gross book value has been marked down for the last 3 years. That's another thing I want to point out. They're also allocating, this is their strategy. They're trying to, again, sell the old and then buy new so they can avoid having this CapEx cycle. So it's just another way. And I think it's a quicker way to get to market rent as well. We kind of talked about the rental caps, but this is what they are, just to show you, like the annual rental guidelines as per the rental board. Ontario's capped the rental at 2.1% for 26, and then they capped it in 25 at 2.5%. Without the cap, they would have been able to 3.1, and then in 24, Ontario had rental guidelines increase 2.5 and 3. Without the cap, would have been able to take 5.9 and 5.6. So you can see the REIT's been undertaking price because of this cap, which is another thing I like, because I know that this will be a catch-up mechanic over time. So you're getting a catch-up mechanic, so you have basically, I'd call it rent in the can. That hasn't happened yet, but once that lease expires, they're going to find a new tenant that will pay the current market rent. And that's something that will happen. Whether the government wants it or not, it's going to happen. And that's another thing I look at when I'm looking at this company today. So they have the company writing down assets. We already know the company wasn't able to push the price as much as they should have in a normal market environment, like a free market environment. So you're able to get that capture at the same time. So there's a lot of things I like right at this specific moment. This is just his verbiage basically saying we're performing well. And to be fair, they have been. The strategy, again, is prudent. You're seeing FFO slowly up. Part of that is because of the buybacks, though. FFO payout ratio is pretty strong. Again, you can see the weighted average shares outstanding going down 5% in the latest quarter, which is nice on top of that 4% divvy rate, 3.9. So you're getting like a 9% yield on it technically, right? On something that's very stable, slowly grows. And I put it almost in the same as a grocery store, right? Because it's grocery store, you have food required. It's the hardest thing to cut back, right? And the shelter is also one of the hardest things to cut back on because you need a place to live, right? These are needs. So when you're trying to think defensive, think what people don't have the ability to cut back on. And that's why we're doing a video on this one today, because it's out of favor and it's defensive at a time when I'm looking at them, because I want some more defense just because of how well the portfolio performed this year. And that doesn't mean I don't get in, like this discount could widen to 40%, right? Then give me a real, like, okay, now I need to really look at this REIT. This is just something I wanted to share with you guys today. And here's the video, or here's the share price. You can see it's back down to 39. I think this is when I probably got out. It was in 2019, right? So basically the market's saying the business is materially worse than it was in 2019. But when I look at the metrics, I can see almost the same occupancy. I've seen net operating income go from 500 million to almost 700 million. So again, 40% better almost. And that's also indicative on the FFO per unit also going up a material amount since then. But I'm getting a better price, materially better price. So that's something I like to look at over the longer run. But you never know how cheap something gets, especially if you have a recession in Canada, right? If I am thinking like, so they should have cut rates sooner and we're going to have unemployment go from 7 to 8 or to 10, right? Those are bad numbers, and this would affect the REIT and give me an even better entry. So anyway, I'd like to know your thoughts. It's definitely an interesting time to look at it. If you have thoughts on the CAPREIT, if it's good or bad, I'd also like to hear that. It's just, I like looking at REITs because I find them very simple to understand. And if you're ever thinking about being a landlord, it's technically a way to be a landlord for more than 4,000 or 40,000 suites. Total residential suites, 46, almost 47,000 rents, right? Anyway, it's a way to be a landlord indirectly and basically get that slow, steady appreciation over time that you normally get. But just that REITs at this current time have been out of favor partially because of higher rates. They've been higher than they should be. And then, so that's leading to them marking down their asset values when maybe they shouldn't be. But anyway, you can see over time, property values slowly go up, rents slowly go up, and the share price slowly goes up. So anyway, I'd like to know your thoughts and have a great rest of your week.